Is there any, when you go and use that big brain and break out all those Excel spreadsheets, is there any way to model for the trade tensions that we are seeing, or is there always going to be sort of a variable where you can't quite pinpoint it?
Yeah, so I think the challenge with the trade tensions is that when you look at the direct link into the economy, it doesn't look all that big specifically for the U.S. because we are a little bit more of a closed economy. But where it does matter is in the uncertainty. So if these trade tensions are lingering, if tariffs are still potentially in play or are getting larger, it could change how companies are planning. They may not invest as much. They may be more cautious in terms of how they think about economic prospects in the U.S. and globally when they're thinking about their plans for the future.
Indications
and you
what's
do,
happening?
yeah, that's been the story now for some time. If you think about the ISM surveys, for example, the headline number still looks fine. But if you look at the components and within the survey responses, companies are saying there's uncertainties. We're not sure how we can plan ahead, and I think that is a big factor.
Joe, how would you expect this to play out as the rest of 2019 unfolds? Do you think we're going to see basically a reigniting of economic growth in the second half of the year contingent on some sort of larger trade deal? Or do you think that it could be a lot worse than maybe investors are anticipating?
It's more of the latter because, to me, the weakness or the projected weakness in the economy is coming via significant monetary tightening. The Fed has taken rates up significantly more than every other central bank. That's what is biting housing and what will slow growth this year and probably keep growth weak in the second half. Last year, growth was 3%. I don't see any trade effects in the data. To me, this is always about monetary policy, liquidity, and risk-taking. And unless you're looking for a full-blown trade war, which to me is extraordinarily unlikely, this is just jockeying. It's Trump laying out the negotiation. I mean, why Draghi would talk about it earlier is absurd. I mean, if the global economy can't handle some tweets by the president, that's just crazy. So my guess is if we slow this year, and that's my forecast, it's because the Fed went too far.
Michelle, your thoughts?
Yeah, so I actually disagree a bit. I don't think that it's as much to do with the Fed's tightening. Yes, the Fed tightened throughout the course of last year. We saw financial conditions respond, but they've eased back significantly. And you think about the interest rate sensitive sectors of the economy, like housing, we're now seeing some really good data. So I think into Q2 and Q3, the cyclical parts of the economy are going to benefit from the fact that the Fed effectively eased. They pulled back after tightening last year. So Q2, I think, is going to look stronger. I think home sales are going to be a bit better. Auto sales already started to rebound. So we've already seen the Fed respond to the fact that financial conditions had tightened and now they've loosened.
Well, Joe, I feel like a cut is not a cut is not a cut. Here's what I mean by that. If the Fed cuts rates because they feel like they went too high on the upside, that's just bringing it back to where they were. If they cut maybe back down to zero, then that's clearly a warning sign. I mean, there are different types of cuts, are there not?
Sure. No, there are. I mean, I'm looking at the tightening relative, one, to other central banks, which can't do anything on policy normalization, and where the Atlanta Fed shadow rate was, and a delta on tightening, which is over 500 basis points. Markets have recovered. Equities have had a tremendous recovery, but that was entirely due to the Powell pivot. And the reason mortgage rates have come down is because as of last week, it's come off a little bit, but the market was pricing a reasonably high probability of a cut by September. If the Fed does not validate market expectations, then I'm going to guess we'll see lower equity prices in the back half, and we won't see the interest-sensitive sectors, which are showing some green shoots. We won't see a continuation of that mild improvement.